Good morning. I'm Peter Lazaroff. As Fred said, I'm the Co-Chief Investment Officer at PlanCorp, and we manage a little over $4 billion for individuals and families just like yourselves, in addition to working with institutions and retirement plans. In my role on a daily basis, I'm charged with helping assist develop and communicate in our investment strategy. And I have the good fortune of writing for the Wall Street Journal and Forbes on a regular basis, typically monthly unless things get real crazy at the office. But what we're going to do today is talk about navigating uncertain markets. We're still hovering near all-time highs. If the year ended right now, this would be a 10th consecutive year of stock market gains. When I read the headlines in the papers, I see lots of call-outs to the fact that valuations are at all-time high, expected returns going forward are lower. You have people worried about rising interest rates. In my little corner of the world, the topic du jour is an inverted yield curve, which we may or may not get into. Trade wars, and so how do we try to approach this? And in my daily job, we are real big believers in evidence-based investing. And that really just means that you're not going to make an investment decision based on your gut, based on a forecast. You're only going to use evidence, and I'm going to try to share with you some of the ways that we use statistics and we use probabilities to help inform decisions on portfolios in an uncertain situation. Because let's be honest, there is always uncertainty in markets. And then the period at which there is certainty is usually the period when something about to go wrong is going to happen. So I'm going to start out with a story here of David and Goliath. Maybe not. There we go. David and Goliath. I think everybody's roughly familiar with this. It's a classic story of the strong versus the weak. The Palestinians and the Israelites were in battle, and Goliath, who at the time was reportedly over 6.5 feet tall, would wear 125 pounds of armor, and he walks up to the battle line and yells to the Israelites, "Send any man forward, and the victor of the battle will enslave the other man's troops." A very big, confident guy. And then you have David. So David's small. He's the youngest of 8. The only reason he's out there on the battlefield is his father had sent him to deliver supplies to his 3 oldest brothers. He's a shepherd, so he's really in charge of just watching the family's herd of sheep. But he hears the challenge, and he goes, well, hey, what's in it for the guy if he wins? And he's told many riches, and you get to marry the king's daughter. And David says, that sounds pretty good. Because I'm protecting the sheep from bears and lions all the time. I can probably take Goliath. And so he goes to Saul, the leader of the Israelites, and he says, I want to fight Goliath. And Saul gives him this look like, I'm not so sure, and starts handing him the armor. And David says, no, I don't need any of that armor. I'm just going to run down to the creek real quickly. I'll be right back. David comes back, and Goliath and he face off, and they have whatever biblical tough guy talk sounded like back then, probably substantially different than what you'd hear in the NFL or NBA. And they get ready to start the battle, and David does something that surprises everybody. He reaches back with his slingshot, takes a rock that he grabbed at the creek, and slings it at Goliath's head, knocks him out right on impact. So there's a few points baked into here. I think the essential one is that David didn't compete in hand-to-hand combat like Goliath wanted him to, like everybody else around him wanted to. The social norm in conforming would have been to go ahead and take all the armor and fight, and he didn't do that. But the other thing is that once he understood his advantages, he was able to simplify things dramatically. He didn't need armor. He just needed a slingshot and a rock. And so what we're going to talk to you today is the tools that you're going to use in terms of navigating markets going forward is finding ways to shift the odds in your favor when so many people are telling you to do different things. Now we're going to start out with a really basic statistical concept. I think I can use it throughout the presentation, and so if you bear with me, and I think this will be very useful for the conversation going forward. So what you have here is correlation between education and income. And I have a plot of 10 points, and in general you see as as years of education rises, income rises with it. And as years of education falls, income falls. So these have a positive relationship with each other. Something that might have a negatively correlated relationship would be something like hours of TV watched and your grade point average. So as you watch more TV, your grades go down. Watch less TV, your grades go up. Ask my parents. It's a real thing. So 3 points I want to hammer home on correlation before we move on. Correlation is the relationship between 2 or more variables. The first example, hypothetical example we used was years of education and income. The second thing is that correlations can range between 1 and -1. And what I have here is just a sampling of what dot plots look like when they're perfectly correlated. and they move up and down together, when they're negatively correlated, so when things move exactly in the opposite direction, and then when there's zero correlation, when there's no relationship between the two variables. This is going to be really important as we look at how to diversify things, what indicators are telling of future returns. And finally, the lower the correlation, the better the diversification. So most people in this room would agree that being diversified is a good thing, but you might not be able to tell me the math reason why. Sure, you shouldn't have all your eggs in one basket. Sure, something could go down and ruin your retirement, but the math behind low correlation, high diversification is extremely important. And what I've done here is I've put a sample asset class with annual returns where in the first year it's earning 20%, the second year it's -10, the third year it's +18, then +22, then +6. Moving all over the place. But if I add a second asset class that's equally volatile, but generally moving in the opposite direction, I can combine those two. If I put half of my money in one and half in the other, what you get is a much smoother ride. So what's important about the smooth ride is that compound interest works far better at low volatility than high volatility. So if given the option, I have two portfolios here. Both have an average return of 10%. One is a low volatility portfolio, one is a high volatility portfolio. Year 10, you see the low volatility portfolio has more money, but they have the same average return, 10%. So what's the difference? Standard deviation is the way that we measure volatility. So if you see standard deviation, just substitute it in your brain for the word volatility. What it's really measuring in a technical sense is how much the different results differed from the average. So in the low volatility portfolio, a standard deviation of 4.5% versus the high volatility portfolio of 18.6. What you have is roughly 4 times the volatility, and as a result, your compound return is much higher with the low volatility portfolio. So all else equal, got two similar return portfolios. We're going to look to try to build the one that has the least amount of risk. So the lower the correlation, the greater the diversification benefit. As I'll give an example of something that people use in most of their portfolios, which is international diversification. What I have up here is decade by decade comparisons of the United States versus global stocks. The United States in blue, global stocks in green. And then you see in this current decade, US stocks are absolutely trouncing global stocks. And so one of the most common questions I get is, why do we own international? Why don't we just stay in all US stocks? And interestingly, when I got into this industry, we were coming in a period where people used to ask me, why do we have so much US stocks and put more in, the world's becoming global, let's invest globally. It goes back and forth. And when you're building a portfolio at the simplest level, you're trying to find assets that zig while other ones zag. And I think this is a good representation of that. Just in your stock side of your portfolio, US and international stocks move differently. These are return streams by the decade. I can look at volatility by the decade, and you see, they tend to differ each and every year. And then perhaps, you're looking at an asset class and you say, okay, United States going back to 1970, which is when the data set for the global stocks began. United States going back to 1970 earned a 10.6 return with volatility of 15.5. And you say, well, why in the world would I add something that has lower return and higher volatility? It's because they're not perfectly correlated. So at PlanCorp, we split our stocks 70% US, 30% international. So if I do that here, what you see is an annualized return that's pretty similar to US stocks, but with a lower volatility. And remember what I said, if you have all else equal, the same return, you want the portfolio that has slightly lower volatility because you're trying to get the most return per unit of risk for the amount of volatility that you're assuming. And we can measure that with something called the Sharpe ratio. The Sharpe ratio, the higher the number, the better. Some people call it risk-adjusted returns, but really what it's measuring is how much return did you earn for the amount of risk you assumed. You can take a high-risk portfolio and earn a lot of return, but that isn't always the best answer, particularly when it comes to compounding returns, which is what your money is actually doing in your accounts. Now, as you think of whether you're adding something or not, the other thing to consider is if I go back to 1970 again, when the global stock data started, there have been 218 months in which the US stock market was down. And in those 218 months, stocks have been down 3.4%. Those same 218 months, global stocks have only been down 2%. So again, when markets are down, something as simple as international diversification can help reduce the loss that you're going to experience. Now, when you're talking about things, you want, from an evidence-based perspective, you want the data to look right, but you also want there to be sound economic logic behind it. What you see up here is a cartogram. It's a map of the world, but the countries are sized by their market capitalization. And the biggest one is the United States by a lot. It's 54% of the market. But there is all of this opportunity that if you're only investing in US stocks, you are missing out on a lot of diversification, a lot of growth opportunity. So logically, this makes sense. But I don't think you all came here to hear somebody say, well, you need international stocks in your portfolio. I'm sure most of you have them. Let me transition to something I would imagine most of you do not have in your portfolio. So global bonds are the largest investable asset class in the world, yet they are the most underinvested place in people's portfolios that I see on a daily basis. And what you see up here is, again, another cartogram of the investment grade market. And the United States only makes up a little more than 30% of that market. There is a lot of opportunity here. Now, when you think about correlations, and remember we had talked about something closer to zero means there's no relationship. You want a lower correlation to have a high diversification benefit. And this is what they call a correlation matrix. And it's comparing interest rate changes among different countries. So if I look along the United States line, I see compared to Australia, it's a 0.48. Compared to Denmark, 0.28. And go out to Italy, 0.26. These are very low correlations. When you're talking about international stock investing, you're typically looking at correlations in the 0.8, 0.9 range. So if you are believers in international stock diversification and you're currently diversified internationally with your stocks in your portfolio, you should doubly, maybe even triply believe in the global bond exposure as well. Because let me show you how much it can reduce volatility. If I look at the Barclays US Aggregate Bond Index and compare it to the Barclays Global Aggregate Bond Index, which also includes US bonds, you see you get the exact same return, but with lower volatility. 20% lower in the portion of your portfolio that should be the safest. So examples of good diversification and bad diversification. Global bonds, great case of diversification, but you have to have trade-offs all the time. Bad diversification often is a matter of, are you worried about missing out on a good idea? Or are you more concerned with implementing a bad one? So the example I use a lot is the FDA seeks to approve drugs that have a net benefit to society and won't have too bad of harmful side effects. Now the FDA, if they set the bar very high, they do risk failing to approve a drug that might help people. And it's very difficult. If you minimize one side of an issue, the probability of realizing another risk comes about. And this is something called type 1 and type 2 error. This is probably the most difficult statistical concept we'll get into today. And I scoured the internet for an image that I thought might help describe what this is. This is the best I could come up with. But type 1 error is a false positive. No, this guy is not pregnant, I'm pretty sure. And I'm gonna guess that this woman over here is pregnant. But when you think about it in your portfolio, what you don't wanna do is add something that you thought was gonna be a benefit to the portfolio and ultimately isn't, while trying not to pass over opportunities that you're a little uncertain of that don't clear your bar. And so if you're gonna minimize type 1 error in your portfolio, you just own index funds, nothing else, call it a day. If you wanna minimize type 2 error, you have to add everything that has a great back test, that has a good return stream, that has an economic story behind it. And obviously the key is to strike a good balance, but in general, my advice, because successful investing is so often about minimizing mistakes, that I'm more concerned with implementing a bad idea than I am missing out on a good one. And that really informs a lot of what we're looking at. So what are some things that can tell you what is a bad idea? I think cost is always one of them. I just have a hypothetical impact of costs where a 1% fee on a fund versus 1.5 versus 2 versus 2.5 over 30 years with a 6% return. A percentage point makes almost $1 million a difference in the end. So fees are extremely important. And this is the way that I think most people hear about fees, is make sure you keep your fees low, your expense ratios low. That is one way to look at it. When you take it a step further, you begin to look at what is the expense of the fund given the return I'm earning. And that's fair, that's good too. Where you take it one step further at PlanCorp to try to identify what is the fee we pay for the diversification benefit. So most things you add are gonna have a diminishing marginal impact on your return. You're not gonna add something in your portfolio and suddenly your portfolio is gonna earn outsized returns. Chances are when you add it, you're going to increase diversification. And there is a way to run a regression of which I won't get into the details of, to back out the impact of the market and say, what is the true allocation alpha? And what I've done here is I've shared a study that was done in the Financial Analyst Journal a few years back, where I looked at the 45 available asset classes for investment, and only 22 of them had allocation alpha or a diversification benefit where fees didn't consume more than 50%. I'm actually gonna flash up all of them. So the black portion of a pie is the amount of fees that is eating into the diversification benefit. So if you had a pie that was all gray and you're investing it, you're getting that full diversification benefit. But meanwhile, if you look over at hedge funds, private equity, emerging market bonds, you see that the fees are destroying the diversification benefit. And I've been pretty passionate about some of these alternative space as well as hedge fund strategies being high cost. I'm going to share with you a chart that from an article I wrote for the CFA Institute titled Hedge Funds, What Are They Good For? And the first line of that article was absolutely nothing, period. So this is one of my, I have not updated the chart since, but from 1998 through 2014, look at the fees and the fund fees and the returns generated by hedge funds. 84% of the profits were captured by the hedge funds themselves. 11% were captured by the fund of funds, so those funds that are buying a bunch of hedge funds on your behalf. 5% of the fees and returns and profits went to the investor. 5%. So I think when you're thinking of, hedge funds get picked on, they're not an asset class, they're more of a strategy, but when you think about non-core investments, when you start going into more complex realms and deviating from a simple stock bond mix, you have to make sure it's in light of cost. Cost is extremely important. But yet so many people do ultimately deviate. And I pulled a quote here from David Swensen, who's the Chief Investment Officer at Yale. He's the one who kind of created the endowment model or the Yale model that encouraged the use of alternatives. And in his book, Unconventional Success, I'll go ahead and read for you. He says, talking heads prattle about the attractions of alternative asset classes. Wall Street pushes vehicles that allow investors to access inefficient markets, and investors require unusual self-confidence to ignore the widely hyped non-core investments and to embrace the quietly effective core investments. So what he's saying here, and in the book, the core investments are stocks, bonds, cash. So individuals, David Swensen is saying, the father of who incorporated this level of diversification in the portfolio, is saying, don't try it. There's a study that comes out from Nakubo every year. It looks at 805 US endowments. The average size of the endowment's about $650 million, and the average allocation to alternatives is 53%. So you have the best and brightest teams dedicated to making alternative exposures work. So you would expect that this is a group who can implement effectively. Because I'll tell you, if they can't implement effectively, nobody in this room, including myself, is going to be able to implement effectively. And so what I have here is a table showing the average return of the 805 institutions, and then I also pulled out the top 25% of performers and compared it just to basic indexes on US stocks, international stocks, and bonds, and then did a blended 60-40. So this blended 60-40 is the blend that we would do at PlanCorp, where 70% US, 30% international among the stock section. And let me drill it down a little further. So we're looking at the average and the top 25 performers. And this is a portfolio you can go and build at Vanguard for 0.1%. Looks pretty good, right? You'd be outperforming all of the biggest endowments in the country for 0.1%. I'll pull one more quote. Scott Malpass is like the Charlie Munger to David Swensen's Warren Buffett. More people have not heard of Scott Malpass, but he spent 3 decades at Notre Dame's endowment. He's the chief investment officer, has an outstanding track record, very well known in the institutional realm. And he says, if I didn't have a team like I have here scouring the world doing 800 meetings a year, looking for the best talent, I'd index most of it. And I argue there are maybe only 50 or 60 investors in the world who can really do this model well. So we're not one of those 50 or 60, I'm sorry. The advisors at big firms, it could be Goldman Sachs and Merrill and Edward Jones and Wells Fargo, they're not one of the 50, 60 either. You know, the advantages that these endowments who can do it are unmatchable. And there's no way that you could drip down that benefit to an individual investor. So we've talked a lot about statistics. You've heard my distaste for alternatives. I'm going to try to lighten it up here and play a quick game to make sure that everybody's still paying attention to me. So this requires audience participation. You don't have to stand up. You just have to raise your hands. So what I'm going to do is give you a series of factors that will help you predict the next 5 years of returns. And I'm going to have you vote for stocks with your right hand, bonds with your left hand, or commodities on your head. And whoever's left at the end, I'll make sure they get a signed copy of my book when it comes out. But what you got here is the most recent 5-year period, cumulatively speaking, as well as the annualized returns. And then you have historical levels of valuation, yield, and inflation versus current metrics. So in round one, equity valuations, they're a little bit rich. Inflation's pretty low. Yields are pretty high. So show of hands, right hand if you think stocks win over the next 5 years, left hand if you think bonds, hand or hands on your head for commodities. Everyone in? It's stocks. So if you said stocks, keep playing. If you didn't, don't cheat. But you can keep playing in your head for sure. All right, so stocks had a big, big win in that next 5-year period. But okay, so stocks took off. They really won. Here's the annualized return high. Yields are still pretty high, and inflation's pretty low. Yields are a little lower than they were before. So again, right hand for stocks, left hand for bonds, hand or hands on your head for commodities. All right. These are common data points people use to predict the next 5, so we're going to see how good we are at prediction. Commodities won. All right, so whoever's answered both correctly, you're going to be in my final round here, where you see that the cumulative performance of stocks, bonds, commodities. So now you see yields are below historical averages. Inflation's a little higher than before. So one last time, right hand up if you think stocks won over the next 5 years, left hand for bonds, hand on head for commodities. Or did I lose everybody? Okay, we still have some participants. All right, it was bonds. I had to make sure everybody won once. Did anybody raise your hand if you got all 3 right? Do we have anybody? Oh, well, I had a bonus question, but we don't need it. It was how many companies are in the S&P 500. It's you laugh, but it's 505. So, you know, I was bound to trick you. But when you look cumulatively over long periods of time, there was always a winner. But if you just held on for the ride, everything delivered you a pretty good return. Now, naturally, we'd all like to pick which sector or section of the market's going to do best. The crystal ball portfolio did great. If you had Murphy's Law and in your head kept getting everyone wrong, well, I'm sorry, that was really unfortunate. But really, if you just stuck with a 64-40 portfolio over this period, and this was a real stretch of 15, I guess 20 years when you include the data, you did fine. You can get by on 8.3%. That's pretty darn good. So we spent time with correlation. I don't want to waste all that knowledge you guys have. What else can correlation do for us? So what I have here is a dot plot again of economic growth compared to future stock returns. And on your left side, you have developed markets. On your right side, you have emerging markets. I don't know about you, but it doesn't look like a straight line like there's a real trend, right? It's basically zero. It's actually slightly negative. And so many people are, how can that be that economic growth and stock returns have no relationship? Well, let's think about what economic data is. It's backward looking. You read it in the paper. It's from the past 3 months or past month or past week, and it gets revised for years and years going forward. Whereas stock returns are forward looking. They're based on people's expectation of a company's future profitability. So, you know, when you're thinking about what's important and what's not important, I think a lot of people spend more time focused on economic data points and economic analysis than they really should. In part because if you're just focusing on the US economy, you're forgetting that the S&P 500 earns more than half of its revenues overseas. And the CEOs of companies are smart people. They're going to go where the growth is. You got to count on that. As long as you can count on people liking money, that's what makes the system of capitalism go. That's what makes stock returns worthwhile. I've been using this chart for a long time. It's from a 2011 study from Vanguard, and what it does is list different indicators and their predictability or their predictive power over future returns, one being great predictability and 0 being nothing. And we have everything from GDP growth, earnings growth, profit margins, the 10-year treasury yield, the Fed model, dividend yield, we have rainfall. All these are over here at like the 0 or 0.16. The two that stand out are valuation. And in this particular case, it's the PE ratio is a 0.38, and the cyclically adjusted PE ratio is a 0.43. So the PE ratio is the amount that you are paying for $1 of last year's earnings. So in March 2009, you might have been paying $10 for $1 of earnings from the S&P 500. Today, you're paying over $20. And so in general, it makes sense. If valuations are lower, there's more upside growth potential. That's pretty intuitive, and that's fair. The cyclically adjusted PE ratio, it's the one with the greatest ability to forecast 10-year returns, and it was made popular by Nobel laureate Robert Shiller, who will be the first to tell you this is the worst short-term indicator ever, so keep that in mind. There's really no short-term indicator that works, 1 year, 3 year, 5 year period. What we can do is look at 10-year, and the cyclically adjusted PE ratio means that you're looking at 10 years of earnings. They're adjusted for inflation, so that you capture the price you're paying for stocks based on a full business cycle. And here I have in the red line the historical average that's derived from data going back to 1902. And then it's surrounded by green lines, which are one standard deviation away from the average. And the reason for that is that when valuations are extremely high or extremely low, that means something. Doesn't necessarily mean anything in the short term, but it does mean that long-term returns might be a little lower. Now, the average you have to take with a grain of salt, because if the average is going back to 1902, I can think of something like US Steel. They had revenue per employee of $90,000 back in 1902. And today, revenue per employee is a little under $500,000. So companies have gotten more efficient. Then you have companies like Facebook that earn over $2 million an employee. And in fact, if you look at the 52 companies in the S&P 500 who report this metric, only one of them has less per employee than what US Steel was reporting in 1902. So companies have gotten a lot more efficient, more productive. You should be willing to pay a higher price for them. The other thing is, how much would you have paid for $1 of earnings when accounting laws didn't exist? You just write anything on your books. Because there's a lot of laws in place now. It wasn't even until 2000 that Regulation Fair Disclosure came out, where you had to disseminate all material information at the same time to everybody. So averages have to be taken with a grain of salt, but there is no doubt valuations are high. If you look back at periods when they're above 25, as they are today, you see the average return is not that great, and particularly over 10 years, 3 and 5 years, annualized returns are flat. At the same time, I include the high scenario because it doesn't mean that we can't have better returns. And I think the way that you're going to look at valuations, you're going to look at future returns over the next 10 years is there is a higher probability of lower than average returns. That's what I'm willing to say. It's not that committal, but it's really all the data truly tells us. If you're saying anything more than that, you're really just putting your opinion out there. I think one of the things you do have to accept as an investor, particularly when valuations are this high and there's a lot of scary headlines in the news, is that losses are an essential part to investing. So in order to earn a return on stocks, you have to give something back in return, and that's losses. That's uncertainty. And if I look, losses are a normal part of the experience. This is just going back to 1950. You can see losses every year. And if you go back to 1926, you'll see that 65% of years had a double-digit loss, and 25% of the years had losses greater than 20% at some point in the year. So it's a normal part. Our view generally is, rather than try to predict when the next downturn is going to occur, you can plan on downturns occurring with the same frequency and magnitude as they have in the past. Peter Lynch, I'll not get the quote exactly right, but he always said that more money's been lost in anticipation of a correction or trying to avoid a correction than in a correction itself. And what happens is, and this is a chart from Newfound Research, they put it out in 2016, so this last little bull market hasn't been updated, but I really love the chart, because what you see is the bull markets and bear markets going back to 1903, and so many people are worried about these little tiny orange guys. And look, they're scary. You should be worried. You should feel frightened. That's a normal human reaction. But if you are worried about these, you miss out on capturing something that's disproportionately larger and goes on for a disproportionately longer period of time. So I think a big part, you can do a lot of planning. You can incorporate through Monte Carlo analysis. You can incorporate the historical frequency of downturns. And the key is to build a portfolio knowing that these losses are going to occur, but making sure that you have the right things in your portfolio, that you're getting paid appropriately for assuming that risk. So what should you do? I have, whether you know it or not, I've covered a couple of these papers already. I think these are highlights of academic research that really informs my own investment philosophy and a lot of what you're learning here today. We have hit on diversification and portfolio risk. We've talked about how risk and return are related. Now I'm going to talk to you about the efficiency of markets and how we can let the market work for you. And because I'm from Missouri, I'm going to do that with cows. My social media, I get promoted stuff for farmers, and I'm like, I do live in a city. But ultimately, meet Penelope the cow. Planet Money's NPR put this picture out to the internet. They were replicating a study done by Francis Galton in 1906. Francis Galton's a famous mathematician. He is also cousins with Charles Darwin, who more people seem to know. But Francis Galton marched a cow around a fair and asked all these butchers, how much do you think this cow weighs? And when he averaged all their guesses, and what he got was a remarkably close estimate of the cow's weight. He said, that is really interesting. I wonder if I happen to ask people who aren't butchers, who know less about cows. So he marches the cow around again and averages the guesses of less informed people, so he thought, and sure enough, it was only 1% or 2% off of the actual weight of the cow. So this study was replicated a couple years ago. It got 17,205 responses. The average guess, I believe, was 1,355, whereas the weight of the cow was 1,280 something. So it was only 5% off. What's going on here? What this is an example of the wisdom of crowds. And when you get a large enough group of diverse opinions making estimates about something, they're naturally going to make mistakes. There's going to be errors in their guess, but they're also going to have bits of information based on personal experience. And when the group is large enough, what tends to happen is errors cancel themselves out, and what you're left with is information. And you can do this with jelly bean jars. Everybody's guessed how many jelly beans are in a jelly bean jar. Now, you try to collect everyone's guesses and average them out yourself and see how it does, but that's the study that's been replicated the most. I just like cows more. But you know what study's even more interesting is that every day in a stock market, 76.5 million trades are placed for $440 billion. Lots of people making guesses on what future cash flow is. And they take all the available information and they try to make a guess based on the prospects of a company, and they make a buy and sell decision. And because there's always someone on the other side of a buy or a sell transaction, you're always trading, that means both people have little bits of error, and the error cancels out. And what you're left with is mostly information. And information gets incorporated very quickly into prices. I have an example here, just kind of flashing back to Trading Places, if anybody's seen that movie, where the orange juice futures, you have fungicide fears, and just in a couple days, price shoots up. Real life example of orange juice futures. Similarly, if I grab when Warren Buffett's Berkshire Hathaway bought Heinz, you see the price immediately spikes, volume spikes, and then it flatlines. So by the time you're reading something in the paper, or you're hearing it on the news, or you're talking about it with friends, there is a very good chance whatever information you have has already been incorporated into price. Because there are a lot of brilliant investors, and there are a lot of big investment firms spending billions of dollars trying to be the first mover. And not only are they using publicly available information that the company disseminates, now people are flying satellites over farmland and oil tankers. They're building custom apps for truckers to use so that they can have more supply data than the truck companies themselves. The level of competition is unbelievably fierce. And this is a big reason why traditional active management has failed year in and year out. What I have here is the S&P Index versus Active report. And U.S. stocks showing U.S. large cap, what percentage of managers failed to beat their benchmark? 93%. 94% failed to beat their benchmark in mid cap, 94% in small cap. You get the point, goes into global. This is over a 15-year period. The study comes out every year, shows 1 year, 3 year, 5 year, 10-year, and 15-year results. The failure rates are all just about the same. It's very hard to outsmart the market. It's very hard to know more than all the information that's incorporated into price. And so some people shrug their shoulders and say, well, sure, well, I'll just buy the best ones. Well, S&P has a scorecard for that too. It's called the persistence scorecard. And it looks at 5-year periods. How did the performance in 5 years go on to do in the next 5 years? So if I take the top quartile performers from 2008 through 2012, and I look at how they did, nearly 50% of them ended up in the bottom half, while 11% of them didn't survive, had to close up shop. So 60% of the winners either were at the bottom of the performance or had to close up shop. So I think this concept of markets being efficient doesn't mean that price is always perfect, but it does mean that systematically beating it repeatedly is nearly impossible. So rather than competing with the market, we're going to emphasize an approach that lets the market work for you. How can we incorporate all the information to help inform us to add things to our portfolio that have higher expected returns? It's a lot like getting your pitch to hit. This is Ted Williams, and I'm from St. Louis, so it pains me that I can't put Stan Musial up here, but Ted Williams is the last guy to hit 400 in baseball, one of the greatest hitters ever. He wrote a book called The Science of Hitting, and it is fascinating the approach he took. He emphasized so much probability and data. When he'd get back to the dugout, he, on a little chart that he did by hand, without the benefit of video and replay, obviously, did something 8 baseballs by 12 baseballs, and he would mark where the ball was and what the outcome of his at-bat was. He was using data when nobody else was. This is from his book directly. And when you accept that there's a lot of information in price and that risk or return are related, then we can kind of do the same thing in the stock market. So I'm going to have here what I'm going to call the total US stock market, where each little gray dot is a company. And the dots at the top, they're the large caps, your Apples, your Exxons. The small cap ones are all companies none of us have ever heard of. This side are value stocks, relatively cheap, whether that's price to earnings, price to book, price to cash flow, and these ones are a little more expensive, the growth stocks. And so I can create a heat map and tell you where the highest expected returns are because of the information that's incorporated into price. And the darker the yellow dot, the higher the expected return. And you see, in general, smaller stocks and value stocks have a lot more opportunity for high returns. The ones over here that are highlighted in growth are largely being captured by profitability. This is looking at an index fund. It's a way of getting broad market exposure. And it used to be that Burton Malkiel, who wrote A Random Walk Down Wall Street, had said even a monkey throwing darts could beat an active manager. And that was true. Research affiliates actually had monkeys throw darts at newspapers over 60 years. And of 100 trials, the monkeys not only beat active managers, they beat the index. They beat the index. Guys, we are smarter than monkeys. I promise. I know we all just met. We are all smarter than monkeys. How are monkeys beating the index of all people? So when you think of stock pages, every ticker and price is the same size on the newspaper print, right? Apple doesn't get bigger font because it's the biggest company. This is what the newspaper, or if they did font size according to where it weighted in an index, this is what it'd look like. And monkeys would be throwing darts at this, and they'd probably beat active managers, but they probably wouldn't beat the index. This is what monkeys were throwing darts at. Look at all that small value. Look at that large value. I still think we're smarter than monkeys. I think we can do this. There are roughly, let me actually give you one more example because I think it's an important concept to understand because I'm going to use the word tilt a lot. And I hear some people don't like the big square. So I have a glass of bourbon every night after my kids go to bed. I have these whiskey rocks. You fill up they get these real big things so it doesn't melt your drink and gets it really cold. And if I have a pitcher of water and I know one ice cube slot is going to be the coldest, I'm going to tilt that and let the water run and fill up that ice cube most. So that's going to make my bourbon taste real good. I'm going to forget about my day. I'm going to watch the baseball game right. I'm going to be happy. That's what we're going to do in the portfolio. That's what we're going to suggest. You still own the whole market, but you overweight to certain areas of the market that have higher expected returns. So there are 315 identified factors in what the head of University of Chicago once called the factor zoo, and I'm going to focus on 6 of them. This top one, what you're seeing is average annual premiums of the different factors. So the top one is the market premium. You earn a premium for owning stocks over bonds because they're riskier. Makes sense to people. Historically, the premium for owning stocks over bonds has been quite large. Secondly, company size, or what I refer to as the size premium. Small caps tend to earn more than large caps on average over a long period of time. The next one, relative price, or what I call the value premium. Cheap stocks, whether that's cheap is according to the book value of a company or earnings. Cheap stocks tend to outperform expensive stocks over time. But they're cheap typically for a reason. I mean, again, it's a risk-return story. And finally, profitability. No one ever wants to argue with me on this one. High profitable companies tend to beat low profitable companies over time on average. These other two are fixed income. When you run a regression, they explain 98% of fixed income returns. I'm going to come back to them and focus on the stock portion right now. But ultimately, you heard me in each of those descriptors, and I will cover questions at the end. You heard me in each of the descriptors mention on average over a long period of time. There is no strategy that's going to work year in and year out. And if I look at the small cap premium and the value premium and the profitability premium and their probabilities of success over 1 year, 5 year, and 10 years, you see that over time, the probability of success rises. So these are not there is no bulletproof strategy in the world. If you're going to take risk, you just want to make sure that you're compensated for it. And you want to make sure that this factor is robust, that it exists across multiple asset classes, in and out of sample data sets. To show you how the impact of time can help with these strategies, I don't expect everybody to be able to read anything, but you can notice the blue and red bars here. And I have the market premium on top, size premium, value, and profitability. And a blue bar is when the premium worked. A red bar is when the premium did not work, going back to 1926. These are just 1 year periods. If I go out 5 years, suddenly you see more blue bars. Go out 10 years, now you really see the blue bars, and they're bigger, much bigger. So when you're thinking about implementing factors, you're looking for things that are statistically significant. And we didn't go into T-stats today. We're just going to show you persistency of something. But these are the factors that we believe are important targeting and have the highest probability of adding return over any type of market cycle. Now on the fixed income side, I'd mentioned earlier, particularly with respect to global bonds, that safety is probably the most important thing in my mind. When you own bonds, they need to be liquid when the market is down. They need to help reduce the downside so that when markets are down and they're up, that volatility is smoothed out, just like we talked about with the lower correlation. Now, there are two things that really drive fixed income returns. The first here is term, so the length of the bond. And what you see here is 1 month, 6 month, 1 year, 5 year, and 20 year bonds. The blue bars are the return, the orange bars are volatility. So the long-term side over here, the 20-plus year bonds, they obviously have the highest return, but when you compare them to the 5-year bonds, look at all that extra volatility, the orange lines, double the volatility from the place that's supposed to be safest. So this little bit of extra return is not necessarily worth all the additional volatility. So I'm going to tell you ought to be living in this range, in this shorter range. I know that I'd have a higher expected return for going out further, but the volatility is going to be so great that it's going to offset the diversification benefit. The other part's credit. And so what I have listed here are investment grade bonds, AAA, AA, single A, triple B, and on the very far right, you have junk bonds. Again, returns in blue, volatility in orange, and junk bonds or high yield bonds, or however you want to talk about them, look at all that additional volatility. It's just not worth it in my mind. We're going for safety, so you might as well live in the investment grade universe. And the reason I say you want to think about safety is that a stock downturn is nothing like a bond downturn. The green line, which I hope you can't see because it's bond downturns, compared to the blue line, which is stock downturns, and the gray shaded areas are recessions, you can see that the worst stock downturn is nothing like the worst bond downturn, which was 3%, by the way, right there. But if I go back even further, that was just to 1990. If I go back to 1926, less than 9% of years did bonds have a negative return, and there were no returns where the year was worse than 10%. So safety. Safety is important. That doesn't mean you can't target your pitch to hit or the place with the higher expected return, but you can't just go all out for return. You have to think about diversification. The common question I have been getting recently is, what about the rising interest rates? What do you do in that circumstance? And so one thing I think that people tend to forget or don't realize until they see the math is that rising rates are actually a good thing for long-term bond investors. And what I've done here is I've taken the US Barclays Aggregate Bond Index. I had a starting yield, it's actually as of January 1st this year, starting yield of about 2.5 and a duration of 6.1. And I increase interest rates one time by a full percentage point, or 100 basis points. And what happens? So when interest rates rise, bond prices fall, and in year one, you see that your return is negative. But by year two, you've turned positive. In year three, you see it continually, steadily climbs higher. Because as rising rates go up, as rates are rising, you get to reinvest your interest in principal at higher rates than you would have otherwise. Now, interest rates don't just rise all 1% at the same time. But this does prove the math that in general, higher rates are going to improve your longer term returns, particularly if you're in bond funds instead of individual bonds, because you can reinvest more efficiently. But what if we stress test this and we have a Paul Volcker type situation where you raise interest rates 300 basis points or 3 percentage points? And what you get would be the second worst bond market ever. But eventually you do come back. I think a rate hike scenario where you're raising interest rates by 3 full percentage points is highly unlikely. You would have to see runaway inflation. You know, the Fed remembers those days. They didn't enjoy those days. My best guess would be we would not have that. But it's a worst case scenario type look. Now I mentioned, the rising rates being good for long-term investors really works best in bond funds. I think the biggest issue people have on their fixed income side is that they are huge proponents of individual bonds for all the wrong reasons. They'll say, well, I know I'm getting my principal back. Well, that's nominal dollars. They say, it's not as volatile as a bond fund. Well, that's because you're not pricing your bond every day. So in general, unless, our general rule of thumb, the bond portfolios are gonna be much cheaper. You can't cost effectively implement an individual bond portfolio until your bond portfolio alone is a little over $10 million. And that's because when people are selling you bonds, it looks free. But what they're actually doing is they are taking yield out of your bond. They sell to you at a price. They take their cut that you never see. And it's actually hard for financial advisors to even track this. There's trace data out there is what they call it now that makes it a little easier. But unless you have the exact time that the bond was sold, you wouldn't be able to tell what the markup was. So your individual bonds are not free. It's eaten out in the return before you get it to it. There's no way of tracking it. There's no way of pulling it out of your performance. So I think the high cost is one thing. The cash drag is the big thing with the reinvestment. So imagine you have a $100,000 bond yielding 2.5%. So it's going to pay interest of $1,250 every 6 months. You can't go buy another bond for $1,250. You're going to have a cash drag. Whereas a bond fund is getting interest payments of much, much greater magnitude. The Vanguard Total Bond Market Fund, for example, and we'll group this in with lack of diversification, owns 17,000 bonds. I don't care. The thing is, when you have individual bonds and maybe they're laddered CDs or maybe there's a series of bonds, what happens when one matures? You buy another one. So what's the difference between your portfolio of individual bonds and a bond fund? You basically are running a small, high-cost, low-diversified bond fund if you're using individual bonds. The other thing is global exposure. You cannot get access to 23 different countries' yield curves with individual bonds. You also would have to place currency hedges, which is complicated, costly, confusing. The case for bond funds is really strong. I think when you get over the fact that my nominal principal is guaranteed to come back to me, yes, that is true, but when you adjust for inflation, ultimately you would have been better in a bond fund. And if you priced your bond every day, it would be just as fluctuating as a bond fund. So in general, I'm going to close with a few things because we talked about how do you shift the odds in your favor so that you can simplify the game. In general, I think people get in their own way. They overcomplicate things. We've talked about a lot of concepts that are not basic. We took a deep dive into evidence-based investing today. But I think at the surface, what we have to do once you have a good philosophy in place is seek to simplify where you can and just get out of the way of compound interest. So I got a couple of my favorite quotes up here on simplification. First from Steve Jobs, "Simple can be harder than complex. You have to work hard to get your thinking clean to make it simple. But it's worth it in the end because once you get there, you can move mountains." Warren Buffett says the business schools reward difficult, complex behavior more than simple behavior, but the simple behavior is more effective. Albert Einstein says the 5 ascending levels of intelligence are smart, intelligent, brilliant, genius, simple. And finally, Charlie Munger, it's remarkable how much long-term advantage people like us have gotten by trying to be consistently not stupid instead of trying to be very intelligent. So how can we simplify the game? I think there's a few advantages that you all have as investors versus a lot of other people. You have a long time horizon. I don't care what your age is. I bet your time horizon is double what you think it is. You know, if you're 80, some of that money is going to your kids, so it needs to be invested with their time horizon in mind. If you're 60, well, data says you're going to live 20 to 30 years in retirement. So you have a longer time horizon. You don't have to report results to anybody. You don't have to print, there's no career risk when you make a portfolio decision. So how can we do things that leverage those advantages the way that David beat Goliath, understanding his advantages? Minimize trading and reduce the number of decisions you make. Every time you make a decision, there's a chance you make a mistake. We make an unbelievable amount of cognitive and emotional errors in our investment process. We could have done a full presentation just on cognitive and emotional errors, but you got to minimize the number of decisions you make, and then the cost of trading, the taxes of trading, all eat into return. So do that. Keep costs low. I don't believe you should have to pay more than 30 basis points or 0.3% for a diversified portfolio. You can certainly pay less than that. But if you want to try to target some areas with higher expected returns, you will have to pay a little bit more. But generally speaking, keeping portfolio costs low is crucial. Every cent that you pay to a fund company is a cent that you don't keep in your own return. Develop thoughtful asset allocation, diversify broadly, and hold fewer funds. So when we talk about risk tolerance, when you set forth a portfolio, you should make a lot of really thoughtful decisions at the forefront. Risk tolerance being trying to decide what is my ability to tolerate risk versus my willingness. Ability is very objective. I can run a model and based on time horizon, your liquidity needs, and the flexibility within your goals, I can pretty much count on measuring somebody's ability to take risk. Willingness is a little trickier. It's subjective. It has a little bit to do with your personal experiences with risk. It's up to me as an advisor to make sure that I assess what you're really willing to tolerate, because I'm building portfolios that are going to lose money in down markets. It's the cost of earning money in up markets and overall. We saw in our guessing game, yes, it would be nice to always avoid the losing asset class, but if you just owned them and rebalanced them, you got a pretty good result. And that's not time period dependent. That works across all long periods of time. The other thing, don't worry about having the most interesting investments. I think that's really important. It's much more fun. The investment I have that I talk to people and think is interesting is this 5-year global bond fund I have, and people are like, that is the most boring thing ever. It is not strike up conversations at cocktail parties, but I assure you it's the most interesting thing in my portfolio. But that's okay. I don't need to have the best, most interesting investments. I can just talk about what's in the news. It's fine. Talk about my kids. Talk about my parents. Set financial planning goals and evaluate those more frequently than your portfolio. So the final thing I'll say is, if you're looking at the market in your portfolio every day, you have about a 50% chance of seeing a loss. There is a plethora of research documenting that we make bad decisions in attempt to avoid loss. It's loss aversion. It's Daniel Kahneman, Amos Tversky, the first ones who popularized it. The less you're looking at it, the more likely you are to see a gain. But in general, you see studies where the people who are checking their portfolios most often are the ones who take a less than optimal amount of risk. So, the market's interesting, but it's not entertainment. It's not a sports team. The media will definitely treat it that way. Good investing is boring. And so trying to think of other things to do other than look at your portfolio other day, that would be a big help in helping you simplify the game. I have a newsletter that you can receive. Many of you picked it up. I'm shocked. I shipped out a big pile of newsletters and you guys took them all. But I send an email out a couple times a month. If you text investing to 22828, you'll get a little message saying, hey, it's Peter. What's your email address? And you'll automatically be added to my emails, which typically come out Monday morning. I believe the next one coming out is not this coming Monday, but the Monday after that. It'll be on hindsight bias. You'll also get a video of this presentation, and I'll try to make sure that the slides are available. But certainly, I'd like to think it's a good resource. I try to educate. It's really easy to unsubscribe if you don't like it after one or two. But at this time, if I have time remaining, I'm happy to take questions on anything I presented, as well as if you want to talk about more timely stuff in the market, in the economy, in the greater global macro picture, I'm happy to do so.